All right, I want to do a video on cash balances and how do you know what is the proper cash level to carry in the context of your overall investments. So this is one of these questions where there's some nuance in here, and unfortunately the brokerage industry and a lot of financial planners, they don't do justice to this question. Partly what happens when you go to, say, a financial planner or when you open up a brokerage account, the system is going to ask you, what type of investor are you? What is your risk tolerance, right? So you're going to have certain choices. I'm a very aggressive investor, or conservative investor, or a very risk-averse investor. These are the different categories they might use. And for each of these categories, there might be sort of a recommended pie chart, basically, of what percent of your assets should be in stocks, what percent should be in bonds, and what percent should be in cash. And so if you're like a moderately aggressive investor, you might have 60% or 50% in stocks, 30 or 40% in bonds, and then maybe say 10 or 15% of your capital in cash, maybe 5% in other, something like that. And of course, it has to add up to 100%, right? So this is sort of, it's one way to look at it, certainly, but to me, it's actually a little bit oversimplified because it's kind of ignores the overall backdrop, and it ignores your specific situation in terms of what does your expense line look like? What do your assets and liabilities look like? So in just to give you an example, let's say you have a $2 million portfolio and the pie chart tells you, okay, you should carry a 10% cash balance. Okay, so that means $200,000 sits in cash. And then, you have X percent in stocks and X percent in bonds. So, but if you're somebody who, you have $2 million in capital and you have an expense line of $200,000 a year, this 10% cash balance, $200,000, that only represents 1 year of expenses, right? That's like barely an emergency fund. Now, okay, so and by the way, if you have $200,000 a year expense line and $2 million in capital, you ain't going to be retiring anytime soon, right? Because that math, you only have 10 times your expense line in capital, and that's tough to do, to retire on that kind of relationship between expenses and capital. So now, in contrast, let's say you're running a $50,000 a year expense line. Now, this 10% cash position on a $2 million portfolio is $200,000. That represents 4 years worth of expenses in cash. Now, that's a little bit better, right? Because now, even if you have a kind of a multi-year bear market or a big crash where you don't get back to, kind of market level that you were at before for a number of years, you can go 4 years without actually having to sell stocks, and in a situation where you don't want to, right? You're never going to be forced to sell, or not forced to sell for 4 years, right? Now, this is a little bit more valuable way to think about how much cash to carry. Think of it in terms of number of years of expenses. And obviously, it sort of assumes certain knowledge, right? You have to know what your expense line is with some degree of confidence, and then, match a cash balance to that, right? And then, I would say 4 years is actually not enough if you're nearing retirement or if you are retired. I'm actually quite conservative with my capital. I never want to be in a situation where I'm forced to sell, and I'm relatively risk averse. And so my cash balance is going to be more than 4 years worth of expenses. That's just going to be how I roll, right? And then also this math kind of breaks down as your capital gets higher and higher, because, if you're running, again, let's say you compound your capital and you have $10 million in capital. So a 10% cash position would be $1 million. But if you have a $50,000 expense line, that's 20 years worth of expenses, right? So then, okay, you could certainly let your expense line drift higher, or you could realize that this 10% is sort of makes less sense the larger and larger my capital stash gets. And so you may want to think, instead of percent of cash, you may just want to think simply in terms of years of expenses and not worry so much about how your pie chart looks in terms of your cash balance. So these are just different ways to think about what is a proper cash balance that are really attuned to you and your expense line, your specific financial needs, and your mindset about investing. And then the other thing to think about too is you want to keep a cash hoard just in place for opportunity, right? Because you kind of never know when opportunity may come by. You might be gifted with maybe a really attractively priced rental property or some business venture that you may want to invest in, and you need to have extra cash sitting around that can be used to do that too, to give you the confidence to make maybe a speculative investment that might work out really, really well. and that there needs to be cash for that too. So this is another sort of dollar figure that you may want to set aside and keep in mind for your long-term financial future too. And then there's a third most important thing to think about cash and what role it plays in your personal confidence making good investment decisions when the chips are really down. So when there's a market crash, we all like to think that we won't get panicked out of our stocks. We won't sell out at the bottom. We all like to think that we'll be confidently buying more stocks as the market collapses, and we'll be standing there buying bravely, right? Well, that's bullshit. We're all going to be terrified and changing our underwear every 15 minutes. And the cash is there to give you kind of liquid confidence, right? And this is another reason why you want to carry more cash rather than less, honestly. I think a lot of investors, they fall into the trap of always wanting to have all their money working for them. And then when the chips really are down, when things are really hairy in the stock market, they can't take action because they don't have enough cash. And, so in this sense, cash is kind of like ammunition. It's kind of like liquid courage to get you to make investments when the opportunities are really good, but like the emotional backdrop is difficult. So these are just different ways to think about cash. The pie chart that we're offered by the financial planning industry, it is too simplistic. And you want to think about it in these other ways as well. It'll help you make better investment decisions when it really, really matters. As always, thanks for watching. I hope these videos are helpful.